What a day Friday was for interest rates, mortgage rates, and the financial market. Let's start at the beginning with the employment figures that were released. The employment number came in stronger than expectations. Up 311,000 new jobs were added in February compared to the expectation of 205,000. The unemployment number edged up to 3.6 from 3.4, which was higher than expectations and actually helps our case for lower mortgage rates. Average hourly earnings is another metric the Federal Reserve watches, and that came in lower than expectations. Bottom line, it was a bit of a mixed report. There are some strong elements and there's some weaker elements. This report, though, will not deter the Federal Reserve from raising interest rates this month at their next meeting. As a matter of fact, expectations were for a 75% probability that the Fed would raise 50 basis points in 2 weeks at their meeting. All that, however, changed abruptly when we got word about a little-known bank called Silicon Valley. Let me explain. In 2020 to 2022, this little-known bank called Silicon Valley Bank, located in California, was the main lender to technology companies, venture capitalists, and startups. During this 2-year period, SVB saw their deposits grow enormously from the same customers they lent to. Essentially what happened this past week was that as these clients withdrew money to keep their companies afloat due to higher interest rates, SVB ran out of money to pay their depositors. On Wednesday morning of this past week, SVB was a well-capitalized bank. On late Wednesday, it had to sell bonds to raise capital to pay these depositors, incurring a $1.8 billion loss. The sudden need for fresh capital coming on the heels of the collapse of crypto-focused Silvergate Bank sparked another wave of deposit withdrawals on Thursday, as venture capitalists instructed their portfolio companies to move funds from SVB. SVB filed for bankruptcy and what has become the second largest bank failure in U.S. history. So why and how could this happen? Let me give you some context on how banks work. When banks take in deposits from people like you and I, they just don't put the money in their vaults and let it sit. They invest it in a variety of ways to get a return. In SVB's case, they saw their deposits grow into the billions from all these companies in Silicon Valley. So what did they do with a lot of that money? SVB invested it in U.S. government bonds. This is considered a riskless investment because it's backed by the full faith and credit of the USA. You can't get a more secure investment than buying U.S. Treasuries. So what happened? As you know, the Federal Reserve has embarked on an interest rate hiking cycle that began in March of 2022, raising interest rates from literally 0 to 4.5, 4 3/4, where we are today, in the shortest amount of time ever. As I mentioned, banks buy U.S. Treasuries with their excess deposits so they can earn a return. What happened in this situation was that because interest rates were so low during the 2020 to 2022, SVB bought a bunch of treasuries that at the time were only yielding 1 3/4 to 2%. When you buy a bond has a maturity. So for example, if you buy a 2-year maturity bond at $100 and it yields 2%, that bond will fluctuate during the life of that bond due to supply and demand and interest rates. Regardless of what happens during the life of the bond, in 2 years' time, you'll get back your $100 plus interest. What happened with SVB was that they invested billions in U.S. Treasuries that were yielding 1 3/4 to 2%. The Federal Reserve then began raising rates at an expeditious fashion, causing bond prices to go lower. So if you're holding a 2-year bond, the price of that bond is much lower than where you originally bought it. If you need to sell it prior to maturity, as SVB needed to, you're taking a huge loss on that bond. So when SVB's depositors wanted their deposit money back to fund their companies, SVB had to sell their bonds at a loss because rates moved up substantially and the price of those bonds were significantly lower from where they bought them. SVB then tried to raise fresh capital, and when the word got out that they were having liquidity problems, it spread like wildfire, spiking a run on the deposit money from the same investors that they lent to. SVB wasn't the only bank that was affected by this. Other regional banks saw their stock price plummet, not to the extent of SVB, but there was clear contagion. As a result, during times of financial stress in the system, investors flock to U.S. Treasuries to park excess monies. That is, they buy copious amounts of U.S. securities for safety, thus driving interest rates lower. And folks, that's why mortgage rates collapsed yesterday. 10-year yields went from 3.96 on Thursday to close on Friday at 3.70. So now the bigger question is, will this cause the Fed to pivot or halt their interest rate hikes? I'm not really sure. We really need to see how this whole SVB contagion plays out next week. If it spreads to other regional banks and becomes an absolute, you know what, then rest assured the Fed will pivot. If we look solely at the data that was released on Friday, I would say there's no way the Fed would have been deterred from continuing to raise rates. We also get CPI and PPI next week. These are huge numbers that the market will be watching closely. However, these numbers may be irrelevant if the banking crisis continues. The good thing is mortgage rates are 6.60, some 40 basis points lower than a week ago. Take advantage of it if you're a buyer, because if the dust settles with these banks and the inflation data is hot, this pullback in rates may be short-lived.